I'm Caroline Hyde in for Emily Chang, and this is Bloomberg Technology. Coming up, the bloodbath at Microsoft as the software giant turns its full attention to the cloud, why thousands of employees are out of work in the rush to get sales staff up to speed. Plus, the investors banking on Britain to keep its title and bragging rights as Europe's leading tech hub. Why VCs are pumping billions into London's technology sector despite the looming threat of Brexit. And embattled co-founder Jia Yuanting's resignation and downward spiral. The Chinese tycoon's plea for more time to repay debt and his focus on electric cars. But first, to our lead, a major reshuffling going on at Microsoft. The tech giant confirmed that it's cutting thousands of jobs. It's been reported that the number of jobs to be cut ranges from anywhere from 3,000 to 5,000, with most of those jobs in sales and outside the US. Now, that's out of the company's over 121,000 person workforce. The move is part of the company's global sales reorganization to better focus on selling cloud software. Bloomberg Technology reached out to Microsoft, and a company spokesperson told us, quote, "Like all companies, we evaluate our business on a regular basis. This can result in increased investment in some places and, from time to time, redeployment in others." Joining now to discuss is Bloomberg editor-at-large Corey Johnson in San Francisco, and here in London, Felix Capital founder and managing partner Frederick Court, who I'm pleased to say is staying with me as my guest co-host for the entire hour. But Corey, bring us up to speed with this, because there is a focus now going on in terms of cloud, in terms of AI, and the memo actually that Bloomberg saw on Monday seems to say that, look, this is all because of a huge $4.5 trillion market opportunity.
Well, and I think it's also about a big shift at Microsoft, right? And it's really about the larger shift in the world of computing, where we've had the world go from sort of a client-server network to things happening on the cloud to a different way to sell software. The PCs are not the center of the environment anymore. Well, guess what? Microsoft built its business and built its staff around the notion of PCs in a client-server world. So as they've made this pivot, they've just decided some people aren't going to be along for the ride. Now, they've also, of course, made some disastrous acquisitions over the years, most notably Nokia, and having to write off all those expensive acquisitions also means writing off a lot of people on their jobs. If you go into the Bloomberg terminal, you can actually see there's a wonderful function for Bloomberg terminal users called loss. You just type in, MSF equity go, and then type in loss, and you see a table with each one of the sort of news stories with the job losses up along there. But you can see the long-term stock price as it goes across there, and all those little circles are job cuts. If I zoom in here, and just since 2014, I mean, look at this: layoff, 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 layoff. I mean, even as the stock creeps up, people are losing their jobs like crazy at Microsoft, and you can imagine the pain that those workers feel, but also the big changes going up at Redmond and in Microsoft writ large.
Yeah, I mean, let's get the take of an investor here, because Frederick, when you look at these sorts of moves, the focus is on the rivalry between Amazon, IBM, Google, Microsoft, all of them wanting in a cloud, all of them wanting into AI. And is that really the shift that we're seeing? It's dramatic.
Yes, no, absolutely. For companies like Microsoft, they are attacked from both sides. They've got a very, very strong position in the enterprise world. And then suddenly, look what happened. Google, which is essentially a consumer-facing company, is now positioning itself as we are an AI-first company. That is bound to impact the enterprise world as well. And on the other side, these small little startups from emerging in the enterprise world from Silicon Valley, guess what? They are now looking to go public, the Dropbox, now the Slack. They are attacking as well the SME and the larger enterprise business of Microsoft, which has got to react.
I mean, Corey, talk us through. It's interesting that some of the reports are saying, look, most of these layoffs are going to happen outside of the United States. Yeah. Is there any reasoning as to why we will see the rest of the international business hit more?
I think what you saw with Satya Nadella is a real focus on getting his ship right, getting his house right first. If you look at the annual cuts, too, while these numbers sound really big, and they certainly are, 3,000 cuts just in this announcement alone, but if you look at the annual job cuts numbers, what you really see is that we go from 18,000 in 2014 to only, and I'm sure it doesn't feel like only to those people losing their jobs today, but or over the course of the next year. But nonetheless, when you go from 18,000 to fewer than 4,000, you can really see see this is a lot more fine-tuning than it is a massive change for Microsoft. And they took the big pain early, which is what all the management people say you have to do when you look at the world of layoffs. You've just got to really be as aggressive as you can early on, not expect to catch up. And so when you look at these pictures we see from their headquarters in Redmond, in the sunny Seattle. Yeah, it's not so sunny up there. Maybe this time of year it is. But indeed, it's the kind of move you would expect this company to make as they start to whittle down as opposed to take giant cuts.
Frederick, when you mentioned there how also Microsoft and indeed Amazon and IBM and Google are seeing the rise of the startup culture starting to eat into some of their pie as well. You mentioned Dropbox, you mentioned Slack. Where are the opportunities to be investing in AI and enterprise startups at the moment?
Well, it's really across all of the stack with AI, and particular in the case of Microsoft, at the application layer. So every task is going to be in the enterprise is going to be somehow AI enabled to a certain level. It's still in the making, and obviously Microsoft has got to react. I completely agree with what has been said as well. At the scale of Microsoft, it's not that big a change. Obviously, it's
about
dramatic.
3% or so.
No, absolutely, but over the years they have had not so great track record of making acquisitions, getting in the online advertising space at the wrong time and probably with the wrong assets, and then mobile making really the wrong pick. The big bet for them was going after LinkedIn, which is not a big asset in terms of value, but not so much in terms of number of employees. It will be very interesting to see where they go next in terms of M&A, because they probably can't find all of the answers internally. Slack, Dropbox could be targets for them as well.
Fascinating. Do we think M&A is on the cards, Corey?
Well, M&A certainly has been in the cards for a long time for these guys. But I think one of the most important metrics to look at, and I'm certain it's one that Satya Nadella and the leaders at Microsoft are looking at, is the revenue per employee. What is the productivity of the Microsoft worker? And if you look over the course of the last 10 years, what you see are two things, right? You see when economic results really hurt the company. So in 2009, and when the recession starts in 2008, you see that big drop in employee productivity. That's revenue per employee. You saw in 2014, when they had to make those first big cuts, a big decline in revenue per employee, and they had to address that. And you see a little decline in 2016. So you can really see that Microsoft is taking this really seriously. They want to grow productivity. They want to grow revenue per employee. And so that's so important for these guys as they move forward. And I think that that's the lens through which we should imagine Microsoft trying to run their business, and clearly taking a big step here, a smaller step than they've taken in the past, but trying to get that revenue per employee up.
And see how analysts react to this. 27 buys and only 2 sells on the Bloomberg at the moment. We'll see how they digest this news tomorrow. Bloomberg editor-at-large Corey Johnson, always great to get your perspectives. So many great charts. Felix Capital founder and managing partner Frederick Kaur is sticking with me. And a stock we're watching for you. Shares of Blue Apron continue to fall since its public debut. Shares closed at $8 a share Thursday compared to its IPO price of $10 a share. And that figure, well, it's a significant cut from its initial IPO target price. Remember, back then it was as high as $17 a share. Now, coming up, we dive into the European tech scene, how the UK plans to defend its title as the top tech hub despite the looming uncertainty of Brexit. And Bloomberg Technology is live streaming on Twitter. Check us out. It's at Bloomberg Tech TV weekdays, 5 p.m. New York, 2 p.m. San Francisco, 10 p.m. right here in London. This is Bloomberg. Now, a story we're watching. Uber is officially rolling out an in-app tipping option for riders in 120 cities in the United States and Canada. Customers will be asked if they'd like to leave a tip when rating their driver at the end of the trip. Now, the inclusion of in-app tipping is a major reversal for the embattled ride-hailing company. Its main rival, Lyft, well, it's always allowed gratuities. Meanwhile, London appears to be defending its title as Europe's tech capital. That's according to London & Partners, an agency for the city. Venture capital firms drove more than $2.3 billion into the city's technology centre since last year's Brexit vote, continuing to outpace other European cities, including Dublin, Berlin and Amsterdam. One firm in on the action, it's Felix Capital, which just announced it's raising $150 million in its second funding round. Based in London, the firm backs some of the city's biggest successes. Think of Deliveroo, for example. Still with us is Felix Capital founder and managing partner Frederick Kaur. Wonderful to have you with us. Congratulations, it's your second fund. I mean, it was only 2 years ago you raised $120 million. Now you're back for more, and you've raised $150 million. Did at any point the fact that you're London-based make any money givers question because of Brexit?
No, it's funny because clearly when we started 2 years ago, that was a big plus and there was no question about it, especially with our positioning around the creative class, London being such a brilliant example of technology and creativity living together. And 2 years in post-Brexit, clearly there were some questions. It hasn't stopped investors from backing us, but the question going forward was more, okay, what kind of opportunities are you going to be able to find in London? Based on the way we work, we tend to go after opportunities based on when they are. We don't expect to do everything just in our home turf in London. So I first met José Neves from Farfetch in Portugal, where he started this company which has become a global platform for fashion and luxury. So our job is to go to find the opportunities and then convince the entrepreneurs to work with us, irrespective of location.
Some of your portfolio companies are fascinating. So Farfetch being one of them, as you mentioned. He's a Portuguese leader now living here. You're in Deliveroo, you're in Goop, which is, of course, a US-based company. What are you focusing on with this second fund? Where do you see the opportunities lying for you that make it distinct?
Yeah. The second fund is very much the validation of our original thesis a couple of years ago. It's still very early in the Felix journey. When we invest, we back companies for the very long term. It takes 5, 7, 10 years to build a company. So we are very much humbled by the interest from the investors. But the premise behind Felix is that we believe that there is an opportunity to have a venture firm that focused on digital lifestyle. By this we mean the emergence of new digital-first brands led by founders, which are impacting the way we live our life, the way we are inspired in different lifestyle segments, from fashion to beauty to food to well-being. Everything is changing through digital, and so we are looking for those founders who have got a sense of what people want, who are building communities in a very authentic, organic way, and where we can help them build a business.
You're going to be writing checks for, is it $2 to $5 million? What sort of level do you see yourself going in at now? Because that's far bigger than a seed round. Is it Series A? Is it Series B? These key numbers keep getting bigger each time.
That's true. That's why we want to be a flexible investor. We are not dogmatic on we want to be the first investor. We want to own so much of the company. We want to back the best founders in the segments we believe in, where we feel we have an angle and where we can see a very big opportunity.
How do you find those founders? How are you seeking them out?
It's both an art and a science. So we've got our tools. We'll use data. We look at signals. I mean, these days, using social media, you can track things. You can measure customer love looking at number of likes on Instagram, on Twitter, and that kind of things. But at the same time, we are very founder-centric. So while we look at data, we like to see passion, we like to see emotion between consumers and a certain product, a service, or a brand. So we combine both art and science, and eventually our business is always about making decisions on partial data. It's never black and white, it's always gray, so you need conviction.
I'm going to be asking you later about the geopolitics in Europe versus US versus UK and Brexit. But I want to ask you now about valuations, because we are looking at companies that, the Nasdaq's down a percentage point on Thursday trading. We see Facebook, those FANGs dominating the most valuable companies in the world. How is it affecting the private sector and the companies you want to back?
Oh, it's definitely, our business is a bit funny because we invest really early, way before potential exits, but valuations are always impacted by public multiples generally. So investing early, really, valuations become more of it's more about some dilution for founders, more about if we invest X, whether it's 1, 3, 5 million, where does that money take the company? And do we believe that the post-money valuation will be fair at the point when the company will need to raise more capital? So we need to be disciplined. At the same time, eventually, we should not be losing a deal on valuation, because if a company works, valuation initially will not be as critical as it might think.
And 150 million that you raised, you actually said, look, books are in excess of 200 million. You had plenty of appetite then there. I know you're not naming who your investors were. Last time it was the likes of Xavier Niel, it was Unilever. Is it institutional money? Is it global money?
Look, we are a startup in venture capital. The bar to back us 2 years ago when we launched our first fund was very high. Even to our surprise, the investor base for the first fund was very institutional. People who understand the venture business, who have opportunities to invest across the US, in Asia, in China, and chose to back Felix because they felt we were offering something different, something they did not have in their portfolio. So the reason why we started Felix was to do something that did not exist in the market, where we give the opportunity to our investors to access a different opportunity. But even more importantly, we want to offer something to founders that they don't feel they get in the market. So the investor base is very institutional. It's pension funds, it's endowments, foundations, family offices. And for the first time now with a new fund, we've got investors from Asia coming in as well. And we were able to broaden the base and get people who can back us for the long term.
Fascinating. We're going to be digging in so much more with Felix Capital founder and managing partner Frédéric Cour. He's going to be sticking with us. We're going to be talking much more about the Brexit debate. But coming up, with the release of the US jobs report coming out Friday, we'll hear from the CEO of HubSpot on how he's attracting workers and what needs to be done to close the skills gap. This is Bloomberg. Now, Berlin-based digital music service SoundCloud is cutting nearly half its staff, or 173 of its 420 employees. It's a cost-cutting move designed to increase its war chest against bigger rivals like Spotify and Apple Music. Now, SoundCloud warned in January it was at risk of running out of cash. Operations will be consolidated into its headquarters in Berlin and an office in New York City. Offices in San Francisco and London, they will be shuttered. And the bigger picture on jobs here, of course, looking at the United States. After years of the payroll growth of around 200,000 a month, hiring has been disappointing so far this year. More and more companies are complaining they can't find the right kind of workers. That's particularly true in tech. On the eve of the June employment report tomorrow, our international economics and policy reporter Michael McKee joins us from Cambridge, Massachusetts, with more on what people are calling, Mike, the skills gap.
Yeah, Caroline, if you're a high-tech company, you've got a presence here in Boston. Google, Amazon, they're all here. And with more world-class universities in one place than almost anywhere, it's no surprise. What is a surprise is the size of the skills gap here. In fact, in Massachusetts, they are ranked last in the U.S. for companies' ability to be able to hire and attract tech talent. We sat down with Brian Halligan, the founder and CEO of the sales and marketing software company HubSpot.
We've probably got 1,700 employees. You probably have 300 or 400 openings right now. Yeah.
How long will it take you to fill those?
Well, we'll fill all those, but it's just continually rolling. We'll open up new openings. So at any given time over the last couple of years, we've had at least a couple of hundred openings at HubSpot. So we're always hiring, we're always growing. We have 1,700 people today. A year ago, we probably had 1,100 or 1,200. So we're constantly filling new spots. Yeah.
What's retention like? Is there a war for talent? Do you have Google and Amazon coming in trying to raid you?
We have a huge war for talent. And I'll tell you a funny story. We did an undercover boss thing today where I manned the front desk at HubSpot and I answered the phones and I had the headset on and greeted people when they came. It was fabulous. And I got about 30 calls over the 3 hours I did it. And I'm going to guess half of them were from headhunters recruiting into our engineering organization. So there is a way, they're just pounding in here. There's not much I can do about that. I don't hang up on them, but certainly pass the call through. We just try to make it a fabulous place to work, and so make it a fabulous place to work and attract the people in and develop them, and if they love it here, they won't leave. That's sort of our attitude on it.
Interestingly, for a guy at the center of higher tech education, Halligan is surprisingly critical of the way the Boston schools are preparing their students.
Now, that's a very interesting point, because I do feel that in the computer software industries, the universities they're on the cutting edge to a certain extent. And what happens in the universities, if the computer science class is a little out of date, they're teaching class, let's say, in Fortran or C or Pascal, some old software language that's no longer relevant, the students themselves are very active doing side projects. And so the students, when they're coming out, are up to speed on the latest technologies and are pretty good about it. They're not way behind. Where the schools, I've noticed, are way behind are in marketing. So we build software to help people market better, and most schools, not everyone of course, are teaching the marketing playbook that worked in the 1990s, not the playbook that works in 2017. Very few schools are teaching how to sell in a way that really matches the way people buy in 2017. And so we're trying to work with the local universities. We work with Harvard, we work with MIT on some programs like that, and we have our own academy that teaches people how to do that kind of stuff.
And citing Mark Andreessen's maxim that every company is a software company these days, every company needs software engineers, Halligan says he doesn't see things getting better anytime soon.
Over the long haul in the United States, I just see the computer software industry eating up more and more industries. And every company today, to a certain extent, is becoming a software company. It's run by software. And so I think the problem gets more acute over time. And companies like HubSpot will have to be very competitive with our salaries. We'll have to make it a great place to work. We'll probably have to open new locations to attract people. We'll probably have to train people. Over the next 10 or 20 years, it's going to get tight.
Like many companies, HubSpot already has its own internal university trying to teach students the skills that they need at their company, perhaps a wave of the future. I got to tell you, Caroline, you and I should have gone into computer programming years ago, especially if we'd become coders, we'd be rich today.
We certainly would be. Woulda, coulda, shoulda, Mike, but great to see you there on the banks in Massachusetts. Thank you very much. Bloomberg's international economics and policy reporter, Michael McKee. Now, coming up, the best possible outcome for Brexit. We'll discuss our investors' approach to startup funding in the UK and across the European region. This is Bloomberg.
I'm Elisa Parenti in Washington, and you're watching Bloomberg Technology. Let's start with a check of your first word news. World leaders are arriving in Hamburg, Germany, ahead of the G20 summit set for Friday and Saturday. Canada's Justin Trudeau, Australia's Prime Minister Malcolm Turnbull, and British Prime Minister Theresa May all touched down today. So have President Trump and Japan's Shinzo Abe. Angela Merkel will play host in her hometown. In the U.S., the lockdown of the Illinois State Capitol building, which was imposed after a woman allegedly threw a powdery substance into the governor's office, has been lifted. It delayed the scheduled votes by the House on measures to override the governor's veto of budget bills. Now, the votes today are the last step in enacting a state budget for the first time in 3 years. Democratic attorneys general in 18 states and Washington, D.C. have mobilized against Education Secretary Betsy DeVos's decision to suspend student loan borrower defense rules. They were supposed to go into effect July 1st. The state prosecutors filed a federal lawsuit against DeVos today, demanding to have the rules restored. California Governor Jerry Brown plans to convene a climate conference next year, part of his latest move to position the state as a leader in battling global warming, even as the White House recedes. The summit, set for 2018 in San Francisco, will mark the first time a state is hosting a climate gathering aimed at upholding the goals of the Paris Climate Agreement. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Elisa Parenti, and this is Bloomberg. It's just after 5:30 p.m. Thursday here in Washington, already heading into the weekend, 7:30 Friday morning in Sydney, where we are joined by Bloomberg's Paul Allen with a look at the markets. Paul, good morning.
Good morning, Elisa. Well, it looks like a pretty unfortunate end to the week with futures pointing 1/3% lower on the ASX at the moment. Nikkei futures looking weaker too after what was a disappointing session on Wall Street. Markets in Japan will get their first chance to react to the earnings announcement from Seven & i, the convenience store operator, out late Thursday with first quarter operating profit a slight miss, $742 million, although Seven & i maintained its full year forecast. The big one today, Samsung preliminary earnings for the second quarter. All suggestions are that that will come in line with estimates for a record high operating profit for the quarter, driven by higher DRAM prices. Elsewhere, labour cash earnings for May will be out in Japan, China forex reserves for June, and it's the second round of voting in the Mongolian presidential election. I'm Paul Allen in Sydney. More from Bloomberg Technology next.
This is Bloomberg Technology. I'm Caroline Hyde. Now, world leaders are gathering in Germany ahead of the annual Group of 20 summit. Brexit and trade will be among the major topics discussed, but not without some resistance. Thousands of protesters took to the streets ahead of President Trump's meeting with Russian President Vladimir Putin. That's going to be at the G20. UK Labour Party leader, that's Jeremy Corbyn, spoke with Bloomberg's Guy Johnson about the future of Great Britain's plan for leaving the European Union.
Listen, we did very well in the election. We didn't win the majority of seats, but we put on a very large number of votes. We put forward a credible economic alternative to this government, and this government doesn't have a majority, has done a very strange deal with the Democratic Unionist Party, and doesn't look to me to be very stable.
So you think things could change quite quickly?
I think things could change quite quickly. We could, at some point, have another election. I don't know when, but we're ready for it. I'm very ready for it.
Very ready for it?
Yeah.
There are many unknowns in British politics at the moment.
You're going to tell me about the known unknowns and
no, I'm not going to. We're not going to get all Rumsfeld for the moment. But one of the great unknowns is where Jeremy Corbyn stands on the details of Brexit, and we hear this all the time. And I'm curious as to why you're being as vague as you are on the subject, and when you're going to provide us with a bit of transparency on your thinking.
Fundamentally, we want to make sure there is tariff-free trade access to the European market, because that's crucial. Half of our trade is with Europe. Secondly, that we do not become a sort of offshore tax haven on the shores of Europe, hence the response I just gave to the Chamber of Commerce speech I just gave, questions now about levels of taxation. Thirdly, that European nationals are guaranteed unilaterally rights to remain in Britain with full citizenship and rights of family reunion. I think that's crucial. And that we maintain that university connections across Europe, and that we maintain a broadly similar level of regulation of consumer products, environmental and workers' rights. And so it would be a partnership with Europe in the future, right, but not membership of the European Union.
So not membership of the Union?
Because we accept the result of the referendum.
Right, so you accept the result of the referendum. Is membership of the single market compatible with Brexit?
Well, the single market is a concept that requires membership of the European Union. And so what we're looking for is a tariff-free access to the European market. Our shadow team, led by Keir Starmer, has had many discussions with the EU officials, members of the European Parliament, and we have a good relationship with socialist parties all across Europe who want to work with us for the future. And I'll be in Brussels next Thursday having an extended meeting with Michel Barnier to outline what our issues are.
That was Bloomberg's Guy Johnson with UK Labour Party leader, that is, leader of the opposition, Jeremy Corbyn. And despite uncertainty surrounding Brexit, as mentioned before, London is still the leader in venture capital in Europe. In the first half of this year, venture capital investment in London-based tech companies reached over $1.4 billion. Still with us is Frederick Koch, he is partner at Felix Capital. And Frederick, we were talking before about perhaps the fact that you're London-based, but doesn't seem to matter. But does it matter when you're looking at startups now? Are we seeing the talent pool, the rich diversity of entrepreneurs still staying here?
Our business is essentially about people. We back entrepreneurs, we provide them with capital, and that's a tool for them to get the best talent around. Going forward, there is a big question on what access to talents people will get in London. And that's true for startups, but that's also true to what has made London the kind of the capital of the tech ecosystem in Europe, probably the most prominent city in Europe, where you've seen Facebook, Google, now Amazon build big campuses. Even now Apple is planning to do that. So these companies come to Europe, come to London to get the best talent. So we will see what happens, but they will need access to the best people.
And therefore, when you look at the $150 million that you just raised in your second fund, and you're looking at where you're going to be spreading it, you're going to be looking globally. But how much do you think would be potentially landing in UK entrepreneurs' hands? We have seen big chunks of change go towards Improbable, for example, coming from SoftBanks. But are you seeing less opportunities?
No. So we have a global ambition for our companies. We are very focused on Europe and also selectively invest in the US, but we definitely are very attached to our European roots and opportunities that have got an element of European angle for us to be relevant, really. It was interesting, the numbers we mentioned earlier with London drawing most of the capital in the first part of the year. There were two big transactions that kind of changed those or skewed those numbers dramatically. Improbable with 500 million and Farfetch with 400 million. So you take those two out of the equation, the numbers look a bit more balanced. So in the past, what we've seen is that London had probably a bigger share of those companies that could attract global capital from SoftBank, from Japan, from JD.com, in the case of Farfetch. So going forward, we'll see where those companies that become the big champion of tomorrow, where will they be based? In London or in Berlin, in Paris, Stockholm or Barcelona?
Let's talk about Paris, because interestingly, of course, I look at the next 2 years of uncertainty facing the United Kingdom. Meanwhile, you suddenly have leaders, youthful, tech-savvy leaders like Macron in France, like Trudeau in Canada. And does France suddenly become a lot more of an opportunity to invest back in your hometown?
Look, if we look at what we've done in our first fund, France has been the first market. So you listen to me, obviously you know I'm French, I can't really hide that. So we do have an angle in the country, but that's not why we invest there. We go after the best talent. And we've been very impressed by the rise of ambition, by the talent that we've been able to find there. And
what sort of companies, what sort of verticals?
So a couple of examples. We look at brands and enabling technologies for brands. So we backed a company in the food space called Frischti, which has created a brand for online access, on-demand access to good food at affordable prices that we backed a couple of months ago. And 2 years ago, we invested in this company called Miracle, which has built a software platform enabling retailers to build their own online marketplace, competing with the likes of Amazon.
How does Europe therefore stack up versus Silicon Valley versus the US?
It's very interesting to see how I've been in this business for over 15 years as an investor, and I've seen the rise of ambition from founders. And now I've got access to three things: the same platforms as people have got access to Silicon Valley. Everybody's got a mobile phone in their pocket, global access to the internet. So you get the same kind of a level playing field. Then better talents. Young, smart people no longer aspire to work at McKinsey or Goldman Sachs. They want to work for Facebook, Google, or the best startups. And third thing is capital. As we've seen, capital can fly from one country to another, and borders are not a limit to that. So it's a very strong environment, and we are very bullish about the potential from Europe to build global players.
I was hoping. It's been wonderful having, of course, Frederic Hoare. That was Insight on Europe, partner at Felix Capital. He's my guest host for the hour, though, and he's going to be sticking with me. Now, a new Bloomberg forecast says electric cars will outsell fossil fuel-powered vehicles by 2040. Now, that's faster than previously estimated. According to new energy finance team in Bloomberg, battery prices will plunge, turning the global auto industry upside down. That will also signal economic turmoil for oil exporting countries. Now, Faraday Future hopes to be part of this electric car push. That's going to be coming up. We discussed the startup that in January revealed the 1,050 horsepower FF91. Now its backer, that's Jia Yuting, is under pressure from debtors. This is Bloomberg. Now, Tesla has not had a good start to July. Elon Musk's company has seen its stock plunge, falling more than 14.5% this week. This is the worst three-day slump for Tesla since February 2016. The tumble was triggered by disappointing second-quarter delivery numbers. And let's dig into the Bloomberg. You just type in #BTV6161 if you're going to get this graph. You'll see Tesla's decline has pushed its market capitalization now back below GM's. Look at that white line below the yellow. Much has made when Tesla, of course, in the white line was able to surpass GM earlier this year. Now, staying with electric cars, and Jia Yuting, who built a sprawling tech conglomerate, will now have more time for Faraday Future, the US-based startup that he personally backs and is trying to raise funds to bring the FF91 electric car to the market. Jia resigned as chairman of LeEco days after a Chinese court froze billions of dollars in assets he controlled. Joining me from New York is Bloomberg's Selina Wang, and still with me here in London is Frederick Kaur, who's partner at Felix Capital. And Selina, take us through the background here. This is such a fall from grace for this Chinese tycoon, and he's now no longer CEO or chairman.
This is the latest thing to happen in the continuing downward spiral of LeEco and Zhao Yuqing's sprawling empire. This once famed executive is now not only a step down as CEO of his listed company in China, now he's stepping off from the board and he's stepping off from chairman as well. And this just comes days after $182 million of his assets was frozen in China after repeated failures to repay interest on loans. Now, this means that he has more time to spend on Faraday Futures, the US-backed startup. But even Faraday is under a lot of turmoil, a lot of trouble. They've struggled to raise money. They did hire a new CFO to try to bring some order and reportedly raise $1 billion. But even then, I reported recently that they faced a lot of executive turnaround only several months ago, and there's still a lot to be worked done there. So unclear if Zhao's fortunes are going to be much better, moving his time more to Faraday.
Frederick, I want to bring you in about the focus on electric cars here, because we've had a lot of it in Europe this week. We've had Volvo, the Swedish company, saying it's going all in terms of electric vehicles. Is this really, how are you seeing opportunities when you're looking at startups, and is this the hot area in terms of mobility?
Definitely. The question for startups, that's another question, because these are technologies that require enormous amount of capital. So we are very conscious with our more limited funds. We are ambitious for what we do. It's slightly outside of our core, but we can definitely see the trend where people, people are very conscious about what we are doing to Earth, and they want to have a better life, and they want to also make Earth a better place, which means start to reduce consumption of oil and looking at alternative energy. So that's a big trend for us to play as an investor. That's not where we are playing, but we are very bullish on that secular trend.
An interesting tie into all of this, Selina, is that, of course, Volvo, its Swedish car automaker, is backed by a Chinese company, and it seems as though China is taking green energy pretty seriously. And you've had a great number of stories also on an amazing amount of funding going into very clean energy, into biking, no less. Can you talk us through it?
There was a whopping $700 million raised today to an only 3-year-old bike-sharing startup in China. It's called OFO. It's backed by Alibaba, DST, Didi, and it's waging a war that is unleashing a significant amount of cash to win market share in this new market. Its rival is called Mobike, and it's backed by Tencent. So they're almost waging this proxy war for Alibaba and Tencent for who can get the most users. Now, this isn't actually bike sharing, though. It's more like bike rental, but rental in the sense that the user doesn't even have to take ownership of making sure that they return the bike and put it in the right spot. They can just leave it wherever they want on the street. So there's significant risk to this model, but the cash spending is not going to stop anytime soon.
I mean, $700 million blows my mind for bikes. Selina, how many countries are they looking on entering? And I mean, they claim when you go on the website that they're already in the United Kingdom. I haven't seen many, it has to be said. But why are they needing quite so much cash?
Well, remember this, it's not really like the Uber or Didi model. Not only do they have to have the back-end system and tracking and allowing these people to unlock it with smartphones, they also have to produce these bikes, and they have inventory risk. So this is very expensive, and it's also very prone to thieves and people who just throw it on the sides of the street. So there's actually been lots of clogs throughout Beijing to Shanghai with these bikes being strewn everywhere. So it's quite expensive. Now, OFO is targeting expansion to 20 countries with 20 million bikes, and they say that they already have 6.5 million bikes in 150 cities. So this is pretty significant global expansion, and they really are neck and neck with their competitor.
I mean, Frederick, I know this is not your typical area of investment, but you are in the lifestyle area and in clean living and healthier living. When you look at the opportunities in mobility, is bikes an interesting one? We see electric bikes, we see car sharing, there's so much.
Yeah. No, I think what's the big trend there that's very interesting is that people have got a very different relationship to ownership. You no longer need to own your car, your bike, and you can just share with other people. And especially when you look at younger people who've got more constraints financially, have got more constraints of space at home as well. They are very much focused on experiences as opposed to owning something. So I think that's the sense of history, and I'm bullish on the opportunity with bike sharing. Obviously, you need to look at the details of the unit economics and the opportunity, but I can very much see a company like this become global and just transform the way people live in all over the world. I mean, look at London. We've got shared bikes, and that's what people are using every day.
A good old Santander bike currently able to be used. Thank you very much indeed. It was a great discussion. Bloomberg's Selena Wang, brilliant reporting as ever. Thank you from New York. Meanwhile, Frederick Hall of Felix Capital, he's sticking with us. Now, coming up, social networks are vying for the rights of the World Cup from Fox. But what is at risk for traditional media companies? We'll discuss. This is Bloomberg. Now, Facebook, Twitter and Snap are seeking online rights to video highlights from next year's World Cup. Now, that's according to two people familiar with the matter. The companies have offered 21st Century Fox tens of millions of dollars for rights to the highlights from the Russia-hosted games that air in the United States. Now, the event is an attractive target for social media companies eager to exhibit more premium video and attract advertisers. But there is a risk that media companies will send too many sponsors. Still with me, Frederick Hall of Felix Capital Partners. And this is a fascinating trend, of course, that we're seeing it more and more. You see Amazon get in with the NFL. You're seeing Facebook already do a deal with European championships when it comes to football, or soccer as they call it in the US. But they just seem to have limitless amounts of cash.
Well, they have a few things. They have a lot of money, but they also have amazing audiences, and for different kind of age groups. My daughter, I've got two of them. One is glued to Snapchat, the other one is glued to Musical.ly. We are using, my wife and I, Facebook and Instagram. So they've got our attention. They've got plenty of money. So why not compete with the traditional media companies and offer that content exclusively to their audience and monetize it very well?
Can I get it exclusively? Well, I mean, will the media giants, the likes of Fox, 21st Century Fox, allow themselves, they might be getting lots of money off the likes of the social media, but it's also harming them to a certain extent.
I think going forward, what we might see is that they will go directly to the rights owners and they can compete directly with them. So we will see when that happens, but I can very much see this coming. Facebook in particular, but also Amazon or even Apple could spend a very significant amount of money, or even take Netflix to go directly to the right owners. So it's part of the transformation of the world. Those companies have got audience and technology platforms to get content in front of people in a very efficient way. I watched your program yesterday on Twitter. It worked really well, Twitter streaming.
Good, I'm glad you did. Well, what about the likes of, who actually ends up owning the ecosystem though? Because we've got also mobile carriers, Vodafone and the likes in Europe, trying to get in and make sure that they own the content, that we're then glued to our mobiles to a certain extent? Or are we watching it via the social media that we happen to be accessing via our phones? So who ends up fighting for this pie?
Yeah. I think what really matters is content. People love, take football as an example, or soccer. People love that. They've got a passion for it. They don't really care where they watch it. They want that content. Yeah. So we've seen price escalating, and I've seen what happened in France, where Canal Plus lost the rights versus SFR, which is a mobile and broadband player, which doesn't really have an audience. But now they've got the content. Guess what? People will go where the content is.
The winner here is the sports companies.
Or it's whoever owns the media. And eventually, it's like commerce. It's all about product. Eventually, media is all about the content. And that's why we've seen the likes of Netflix or Amazon start producing their own content, which is not something you can do so easily in sports or football. But now we start to see this with technology companies investing in esports to create their own leagues.
It'll be a fascinating way that this continues to evolve. It's been wonderful having you here as well throughout to get your insight throughout. Frederick Court, his partner at Felix Capital, of course, announcing the new fund they've raised, and he's been my guest host for the hour here in London. Now, that does it for this edition of Bloomberg Technology, and a reminder that Monday begins our Focus on Tech Week, showcasing the breadth, the depth of Bloomberg's expertise and taking advantage of our multi-platform global reach. We'll be talking to leaders in tech, including former Twitter CEO and current partner at Index Ventures, Dick Costolo, Reddit co-founder Alexis Ohanian, and Dave Clark of Amazon. This is Bloomberg.